In the previous session, we figured out what a trend and a flat are and learned to see the basic structure of the market. Now we need to understand how this structure is displayed on the chart. Price is movement, but we don't see the struggle of buyers and sellers directly. We see it in the form of a chart, and how exactly it is displayed affects our perception of the market. The trading platform has three main types of charts: line, bar, and candlestick. Let's break down each of them. Line chart, simple but little information. The line chart is the simplest. It is built on closing prices. The platform simply connects the closing points of each candle with a line. This chart is convenient for a general understanding of the direction of movement. It removes unnecessary details and shows the structure in a simplified form. However, the line chart does not show what happened inside the period. We see neither the highs nor the lows, nor where the price opened. Bar chart, more details but harder to perceive. The next type is the bar chart. The bar already shows four values: the opening price, high, low, and close. On the left of the bar is the opening mark. On the right is the closing mark. The vertical line reflects the range of movement for the period. Bar charts were especially popular from about the 1990s to the early 2000s, the era of active development of technical analysis terminals. However, with the growing popularity of Japanese candlesticks, traders gradually began to prefer candlestick charts because they are more visual. The bar chart gives more information, but visually it is less convenient for perception, especially for beginners. Candlestick chart, the standard of modern trading. And finally, the candlestick chart. Candlesticks are the standard of modern trading. They display the same four parameters as a bar: open, high, low, and close, but they do it much more visually. The body of the candle shows the difference between the opening and closing price. If the price closed above the open, the candle is bullish. If below, it's bearish. The shadows, wicks, show where the price went during the period, the highs and lows. It's important to understand, a candle is not just a shape. It is a reflection of the behavior of market participants over a certain period of time. Japanese candlesticks, history and logic. A bit of history. Japanese candlesticks appeared back in the 18th century in Japan. They were used by rice traders on the exchange to analyze the balance of supply and demand. It is believed that one of the first to systematically apply candlestick analysis was the trader Munehisa Homa. Initially, candlesticks were created precisely for understanding the psychology of the market, and in fact, they still perform this function. But there is one key point. The candle itself means nothing without context. The same shape can have different meanings in a trend and in a flat, on support and in the middle of the range. Therefore, we will not study the names of candlestick patterns as separate magic. We will understand the logic, what happened inside this candle, and why. Practical assignments and what's next. Your task after this session: switch the chart between line, bar, and candlestick formats. Determine how the perception of movement changes. Choose the candlestick format as the main one for further work. Find several candles with long shadows on the chart and try to explain what happened inside them. No need to complicate things. It's important to learn to see the logic of movement, not memorize shapes. Additional assignments in the video description will help consolidate the material. Complete them to start perceiving the candle not as a picture, but as a reflection of the behavior of market participants. Write in the comments which chart you used before and whether you will now analyze the market differently. In the next session, we will analyze how to quickly read candles in the context of market structure and why most beginners misinterpret signals. See you.